Unfortunately, what has happened, at least over the last 4 or 5 years, everybody is talking about investing. But you don't want to be in a stage where all you are doing is investing and not living your life.
How an average salary goer can achieve that 10 crore number by 40?
I think, Sonia, very honestly, you need a mixture of good education and a little bit of luck. Because investing is actually a mixture of mathematics and practicality.
What are the funds in your portfolio and why did you choose them?
I invest across 4 or 5 funds. If you can do this in probably 180 months or 15 years, you can actually achieve financial independence.
Very interesting to me that you don't buy direct stocks. Why is that?
I think very honestly, I don't think I really have the skill set.
Owning or renting a house.
So look, for all mathematical purposes, you and I both know that the answer is renting.
As a 25-year-old, where do you invest? How do you begin? Which are the mutual funds to look at? Just simplify it for us.
So,
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Thank you so much for joining us. Now on today's show, I have someone with me who is not just a certified financial planner, he is also someone who's a financial educator. He's very popular on the internet and he's someone I've known for many years. Kirtan Shah of Credence Wealth is here with us. Kirtan, thank you so much for joining us.
Sonia, thank you so much for having me.
So, I think this conversation has been long coming. We've been planning it for a while.
Yes.
And the reason I have you here is because a lot of people on our show tell us that, when you talk to fund managers or PMS managers, right, they have, it's sometimes not very relatable.
Yeah.
Like they talk about, behavioral finance, investing for, creating large wealth for yourself. But a large section of the population are salaried guys who make, say, 1 lakh per month, 2 lakhs per month and don't know how to start. So this show is for them. And it's also, the title of the show is How to Make 10 Crores by the Age of 40. So I've chosen that number because it doesn't seem very unachievable. And it's also something that you can comfortably live with, say, in a metro like Mumbai, Delhi, whatever, right? And it's something that you have achieved. So I thought, why don't we get that secret sauce from you on how an average salary goer can achieve that 10 crore number by 40?
I think, Sonia, very honestly, you need a mixture of good education and a little bit of luck. Now, why do I say a little bit of luck? Because investing is actually a mixture of mathematics and practicality. I can give you a lot of numbers around how do you end up achieving this number, right? But practically, you will actually need discipline to be able to reach that number. And at the same time, you will have to make sure that you don't want to compromise on your standard of living. Because unfortunately, what has happened, at least over the last 4 or 5 years, everybody is talking about investing. But you don't want to be in a stage where all you are doing is investing and not living your life. So maintaining that fine balance is going to be a tough task, right? So let's cover both. Let's cover mathematics and let's cover the emotional side of it. Or what will you really need to compromise on for you to be able to reach that number?
Okay. So first I wanted to ask you, if you have, like in today's day and age, right? If you're a 25-year-old and you have plans, so you want to get married, you want to have kids, you want to buy a house, etc. What is that ideal number that you would need by the time you're 40?
I think because I have been able to do what the title of the show is, I think for somebody who's ambitious, that's a good number.
10 crores.
10 crore is a very good number and I think it's predominantly achievable in my opinion. Because if you look at a 25-year-old and if you are educated, you have, let's say, a 2 lakh rupees salary to start with, I think this number is doable. So there is a very simple rule that I follow and I've been doing it for a long time, which is the 30-30-40 rule. What it typically does is tells you that 30% of your income should be the maximum expense that you would want to do, right? 30% is the maximum EMI burden that you want to take on your head, right? And the remaining 40 can get invested. If you can do this in probably 180 months or 15 years, you can actually achieve financial independence. So let's say if we talk about this 2 lakh individual, right? So we are saying 60,000 is the monthly expense, which is 30%.
So let me just reframe the question. If someone is earning, say, between 1 and 2 lakhs per month, right, and they want to achieve financial independence, how do they do it?
So I think it's exactly the same what I just said. I think if you follow the 30-30-40 rule, in 15 years or 180 months, you will be able to achieve financial independence. What I mean by that is, let's say if you have a 2 lakh rupee salary, you put 30% of your salary as the maximum expense that you will do in a month. 30% as the maximum EMI that you will have. And the remaining 40% is what you end up investing. And if you are able to do that for 180 months, which is 15 years, at a mere 12%, you will actually be able to achieve financial independence, right? And
so when you say financial independence, you mean you can achieve that 10 crore figure, or that you won't reach that by?
No, you won't reach the 10 crore number, right? For 10 crore, your salary has to be slightly higher for this 30-30-40 to actually make you reach the 10 crore number.
But which you would assume, right? Given that every year you would get an increment, but then the other angle in this is also lifestyle creep and certain, life decisions that you make, whether it's buying a house, paying the EMI, children's education and all of that. So
there are so many of these things that will be a part of your ongoing discussion for you to decide whether what to put more priority on, right? But if I can just randomly throw some numbers so that it's slightly more clear for the audience who's hearing us. So let's say I was talking about the 2 lakh salary number, right?
Yeah.
So if you divide the 30-30-40 rule in the 2 lakh salary, so you are saying 30%, which is 60,000, is the maximum expense that you want to do. 60,000, which is another 30%, is the maximum EMI that you want to have. And 40,000, which is 40%, which is 80,000, is what you want to invest, right? Now, let's say if 80,000 is what you start investing every month, and assume that you are topping up the salary by 10% each year. The SIP by 10% each year, which means next year your SIP will become 88,000, right? So on and so forth. What typically happens is 15 years, even at a 12% assumption, you will reach close to 7.5 crore.
Okay.
Right? Of course, we are talking about somebody who's drawing 2 lakhs.
Yeah.
We are talking about
somebody who can take out 80,000 rupees per month, which is like a very, very small portion of the population.
Absolutely. Now, which is why I said you have to be slightly lucky along with the math working in your favor. Why lucky? Lucky can be on two fronts. First, let's say if you are staying with your parents or you have a house and you don't need the EMIs. If you are in such a situation, then doing an 80,000 or a lakh will not really be a problem, I'm assuming.
Correct.
Right? Or let's say if you are decently educated, then your career path grows much faster than the normal average Indian career path will grow at, right?
Correct.
So you will be able to do a much higher incremental investment over a period of time, which is going to make your journey to reach the 10 crore much easier and much faster. So it's a fine balance between mathematics, how much can you practically do, and how lucky are you, whether do you have a house, do you need to buy a house, or how fast your career grows. And which is why I keep telling a lot of people that I interact with that if you really want to invest, first invest in education. Because if you really want to be able to create wealth, right, it is only going to happen if your investable surplus, how much can you invest every month, is very high, plus you are able to generate higher returns. Now what is not in your control is you are not in control of being able to generate higher returns. What is actually in your control is to be able to have a higher disposable investment each month or each year. So if at all your career does well, right, you will have this higher disposable investment that you can do each month. And because you can't control return, all you really want to control is to be able to invest higher each month or each year, and the number that you are trying to achieve will become easier, right? So if your career is doing very well, and if that's your focus area, automatically your investable surplus will increase, and hence the number that you are looking at investing will become much easier versus trying to do the undoable is try and generate higher returns. A lot of people, unfortunately, over the last 4-5 years, has started focusing on trying to generate higher returns, learning finance,
Trying to trade.
yeah, trying to make this a career, right? Whereas you actually want to focus on what your
Skill set is, so you can
skill set
earn more
is.
money and invest
Yes,
it.
so focus on trying to invest more money than trying to create higher returns.
Correct. That's a very, very interesting point. So let's go with the assumption that the sweet spot is 30-30-40, right?
Yeah.
So 40% of your income, whatever it is, say you are earning 100 rupees, 40 rupees should be put into investments every month
Yeah.
through the SIP route, and
Yes.
then you do a step up SIP.
Yes.
All right. Now that 40 rupees, let's try and break it down. I want to understand from you, since you have achieved this number, as a 25-year-old, where do you invest? How do you begin? Which are the mutual funds to look at? Just simplify it for us.
So I can tell you what I do for myself, right? And I'm assuming because we are talking about somebody who's 25 years old, she has a very high investment horizon, right? Of course, she is free to remove money whenever she wants to because this money is liquid. But the assumption is that the time horizon is quite high. Probably the risk-taking capability is high because we are assuming that the focus is career and hence investable surplus will be higher. So the risk-taking capability will be higher. Now, keeping both of these things in mind, I think the best way to go forward, or the way I do it, is put 80% of your investments into domestic equity, India equity, right? And I put the remaining 20% floating around fixed income, gold, and global equity, right? Now, look, everybody may not be able to do this. So for everybody, you focus on an asset allocation where 80% is equity and 20% is fixed income plus gold. But if I have to tell you about me, 80% is domestic equity and 20% is more tactical in nature, where it keeps moving around gold, fixed income, and global equity. Now,
And global equity, you invest how?
through
mutual
ETFs
funds? Through
and through
ETFs.
mutual funds.
Okay.
Yes. Now, this 80% that we are talking about in domestic equity can be split into equal halves of large caps, mid caps, and small caps, right? A lot of people unfortunately think that, because they have the risk-taking capability and the time horizon, they want to put all that money in small cap with an assumption that they will make more returns, but it does not really work that way. You look at the last 10 years, small caps have done 16% CAGR, but mid caps have done 19% at a lower risk, right? So the assumption that because I have the risk appetite and I want to be able to generate higher returns, putting everything in small mid may not work. So the sweet spot, in my opinion, look at the last 20-25 years of data, is equal halves of large, mid, small.
Okay.
Right? Now, when you do equal halves of large, mid, small, your risk is slightly higher than large cap and your returns are close to mid cap, which actually builds a portfolio for you in a way where your risk is slightly lower, but returns is slightly higher than the risk that you are taking. That's the optimum portfolio that you really want to end up making, right? So, equal halves of large, mid, small, and within those large, mid, smalls, do not try and take too many funds on board, right?
What's the ideal number of funds one should have in their
5.
portfolio?
4 or 5 funds should be decent. And I'll give you an example.
That's it, including index funds.
100%. And I'll give you a reason why. Look, let's say there are 5,000 stocks listed on the exchange, right? There was a very good data that I was reading by DSP Mutual Fund, which said that probably 57% of Nifty 500 has not been able to beat gold prices.
Yeah.
Right? Which in simple language means that if there are 5,000 stocks listed on the exchange, there is going to be a large bunch of stock which is not going to be able to beat most of your traditional investments.
But to be fair, all these analyses have come now in the last 1 year because gold has surged in the last 1 year. If you compare,
I will agree.
if you remove these 2 years aside, then equities has always outperformed.
100%. Even if you remove the last 24 months, gold is still at a 11.3% CAGR for the last 20 years.
Correct.
But the point that we are trying to make is that if there are 5,000 stocks listed on the exchange, not all 5,000 are going to do well. So the reason why you pick a mutual fund investment is because you want somebody who understands, who's the fund manager, to be able to pick 40-50 stocks which are going to do well in the coming year, and they continuously keep a track of it. Now, if you have, let's say, 20 funds in the name of diversification that you get on board, and each of those funds have 50 stocks, even after removing overlaps, you will still own 750 or 800 stocks.
Yeah.
That does not solve the problem that you are trying to solve in the first place by getting mutual funds on board.
Correct.
Right? So I think 4-5 is a very good number to look at. And within this 4-5, because you've split across large, mid, small, right, you have the diversification in place at market cap level. You will have 4-5 different fund houses that you've got on board. So you will have a diversification at the AMC level, right? And the third level of diversification that you actually need is at the style level. Now, what do I mean when I say at the style level? You go 10 years back, the heroes in the mutual fund 10 years back were very different than the heroes 7 years back, or the heroes 5 years back, or the heroes today. Right? So every 2-3 years you will see
The leaders of the market change.
leaders of the markets are changing. The names who become popular are very different than the names which were 5-7 years back.
Correct.
One very important reason why this happens is the style of investing. Now, what do I mean when I say style of investing? If you break mutual funds down largely, there are 3 styles that the fund managers are opting today in the MF world. One is value style of investing, another is growth style of investing, and third is momentum style of investing. Now, in a 10-year time frame, you will have 2 or 3 years that one style will perform, right? Let's say at the end of the 10th year, probably all 3 styles will sum up or collide to generate 1% upar niche kind of returns. But you will have time frames within these 10 years where one style of investing will do very well over the other style of investing.
Correct.
Let's say today, value style has done far well over momentum over the last 1.5-2 years.
Yeah.
Right? So you might have a 10-year view, right? But you also behaviorally want to be in a situation that you are not significantly underperforming in that 3-year period, right? And which is why the best combination is to have all 3 styles of investing put together. So you build a portfolio in a way where you have value also, you have growth also, and you have momentum also, right? So what you will end up doing is, from those 5,000 stocks, if you have only 4-5 funds, your concentration will be 100-120 stocks. You are spread across AMCs, and you are spread across large, mid, small. At the same time, you are spread across growth, value and momentum. That's the perfect diversification that you can bring on board, and you can actually do this with only 4-5 funds.
So I'm very curious to know what funds you own, and I want you to break it down for me. What are the funds in your portfolio and why did you choose them?
So I invest across 4-5 funds largely. So the large cap, so this is not theoretically large cap, but it's a large cap, predominantly large cap focused investing the way I look at it. So for my large cap exposure, I have SBI Contra and PPFAS FlexiCap. Okay. Right? Of course, these are
cult favorite,
PPFAS. These are not predominantly large cap funds, but I look at them as
PPFAS and SBI?
SBI Contra.
Contra, okay.
Right? Also, largely value style of investing that I'm looking at adding to the portfolio is what these funds bring on board.
So why did you choose value? I know that PPFAS has value style investing, but they do a mix actually of value and growth, but largely value. SBI Contra, can you tell us a little bit about that fund?
Again, because it's Contra, what it is trying to do is not buy into the momentum that the market is looking at, right? So let's say today, if hypothetically, if defense or manufacturing is what is the flavor of the season, you will typically see probably a Contra fund buying into a pharma or an IT.
Oh,
right?
Interesting.
So the idea of a Contra fund largely and not going too much into the technicality is to buy something that is available at probably a slightly lower valuation today, right? So
that's the SBI Contra fund is a big chunk of your portfolio, is it?
Yes, so I have largely four funds that I invest in.
Okay.
And 25% is spread across SBI Contra, 25 is PPFAS, and the remaining 25 is split across Edelweiss Mid Cap and Nippon Small Cap.
Okay.
So again, if you look at the composition, it is exactly what I what I just answered a while back. So what I've done is there is large cap, there is mid cap, there is small cap. It is built in a way that there are only 4 funds and the exposure is close to 100 odd stocks, right? Of course, to be specific, Nippon.
It's a fund that has done very well, but in the past.
Yeah,
Yeah.
lately because
it
of the
started.
AUM that it
Yeah.
has built, now that single fund is at 200 stocks.
And the outperformance is now getting tougher.
It will get tougher in the small cap space with that large an AUM, but I think Sameer's been able to do a fab job there, at least in my opinion. So split across large, mid, small, there is value, there is slight momentum, there is growth, the way the portfolio is built. And I
Very
think-
interesting, actually. Let me digest that. So, 4 funds:
Yeah.
SBI Contra Fund, PPFAS Flexi Cap Fund, Nippon Small Cap Fund, and you said
Edelweiss
Edelweiss Mid Cap. Edelweiss Mid Cap is an interesting decision because in the mid cap space, there are many fund houses which are larger and have performed better.
Correct.
So, how do you feel about that?
See, I will tell you my understanding about about mid cap has completely changed post 2018, right? So 2018, when the SEBI categorization kicked in, where SEBI said that top 100 market cap stocks are large cap, 101 to 250 is mid cap, and 251 and below is small cap and micro cap. This changed a lot of things for me and the way I started looking at investing post 2018. Because pre 2018, a large cap fund was technically still a large cap, but they had the freedom to do a little bit of mid cap and small cap here and there. Now they are restricted to 80% large cap and 20% something else. Now that has frozen the capability of the fund manager to be able to, in spite of thinking that let's say large cap may not be fairly valued, they can't do anything outside of the top 100, right?
Correct.
So that restricted themselves in the large cap space, and hence I from then on started looking at flexi cap funds as pseudo large cap, which is why the PPFAS flexi cap or the SBI Contra is what I look at large caps now.
Okay.
Now look at what has happened in the mid cap space. In the mid cap space, you have to invest 65% in mid cap and 35% can be elsewhere, right? Since 2020, a lot of money has started flowing into mid and small as a space. Now, if 65% of the money has to compulsorily go into only 150 stocks, right, and a very large pool of liquidity is continuously flowing into mid cap, which is why this space becomes very expensive very fast. More the liquidity, see in the large cap space, you have quite a lot of liquidity absorption capability in the top 100 stocks. It may not be in the next 150 stocks because of the kind of liquidity that the mid cap space is now attracting, right? Fund managers have no other option but to pour that 65% of the liquidity that they are getting into these 150 stocks. So these 150 stocks, which is why in my opinion, are becoming far more expensive far quickly than the small cap space. What is happening in the small cap space is you have still a very large universe that you can actually end up deploying that capital, even if there is a lot of liquidity that keeps coming in, right? So mid cap, unfortunately, is taking the brunt, in my opinion, of a lot of liquidity that is getting attracted towards the mid and the small. So in the mid cap space, you will have to be very cognizant of the fact that you don't want to go with a very high AUM fund, right? Or you want to be slightly more conservative or slightly more technical in terms of making sure that you have the right mid cap fund in your scheme of things, because in my opinion, this problem in the mid cap space will continue of overvaluation as long as mid cap funds will continue to receive larger capital.
But it's very interesting to me how you don't have any of the larger fund houses, right? Whether it's an ICICI, whether it's a Kotak, whether it's an Axis, like a lot of that is missing in your portfolio. I mean, of course, you have SBI Contra Fund. Why do you think that is? And how long do you stay with a fund typically? Because you have only 4 funds in your portfolio. Do you stay with it for a 10-year period? How do you review it? When do you switch?
So I don't switch my funds quite often.
Okay.
I think it's only the mid-cap fund that actually got switched a couple of times, but Nippon Small Cap has been around for quite some time now.
Yes.
PPFA has been quite some
Yes.
time. SBI Contra has been a part of the portfolio for quite some time. What we typically do is, because I run wealth as a business also, right? There are some 29 funds that we've shortlisted out of the universe of funds that are available in the MF space, depending on our qualitative and quantitative data points. And there are these only 29 funds that forms a part of our universe for our own investments and for our client investments, right? All we do is every month we re-evaluate all of these 29 funds on those 21 parameters basis which we actually shortlisted them. Now look, it is impossible that every month when the fact sheet comes out, all of these 29 funds will be able to ride through the 21 data points on which we originally shortlisted them. But which is why we have those 2-3 points which are non-negotiable, right? If those 2-3 points happen, then there is a trigger that we will check whether do we still want to continue with this or not, right? And we decide whether we will switch or still want to continue. So largely, to answer your question, largely what we do is these funds are evaluated every month, right? But it does not mean that there is going to be a change every month. Change, probably in my experience of having been doing this for 9-10 years, is change happens for us anywhere between 24 to 30 months, and that happens once. That will be because probably the fund's objectives have changed, the fund manager has changed, right? Or something significantly has changed where the fund says something but does not do it, right? So you will typically, because we've been observing these funds for a long time, we know there is a pattern that the fund follows, right? Do they stand cash or not? So let's say the fund manager in their commentary says that we will stand cash when we feel markets are expensive. But when the markets are actually expensive, they don't do it, right? Or if there is a fund manager change, and because we are very strict with growth, value and momentum, right? So let's say as a fund, the original fund manager was a value style investor, but the new fund manager who's replacing has actually done growth or momentum style of investing, then it's a red flag for us.
Okay, so from all the data that you have analyzed, right, about funds over the last many years, if I'm a 25-year-old who's just starting my career and who's earning between 1 and 2 lakhs per month, and I had to invest in 2-3 funds in 2025, which ones would they be?
So first is, from a large cap perspective, do index, right? Get a PPFAS on board to do a large plus mid. Of course, this is not the category of the fund, but large plus mid space can be occupied by PPFAS.
Like a flexi cap fund.
Yeah, because it will also give you some exposure to global investing, while today that's not the case because of the RBI mandate and all of that, but it'll still give you some exposure to global equity. And do Edelweiss mid on the mid side, and probably a Nippon small or a Tata small on the small cap space. I think you can either largely copy my portfolio at this point in time, or change Nippon small with a Tata small and an SBI Contra with an index, right? That may be a very good fit to start with. But
so you don't have any passive funds, index funds in your portfolio?
No, because I largely believe that bid and small specifically will be able to generate decent alpha, in my opinion. Large cap space, I think there is a challenge for funds to be able to generate alpha, and which is why, like I said, since 2018, we don't do large, we do flexi, right? Because then it gives the fund manager the ability to, kind of do a little bit of mid and small also.
Be a bit agile in stock picking.
Absolutely.
Okay, that's interesting. Yeah, I mean, I don't think we've ever spoken about this before. It's very interesting to know your portfolio and what you invest in. So just 4 funds. That's great.
Yes.
And any PMS?
No, I don't do PMS largely. I do some direct equity, but that direct equity is also on the large cap side.
So I saw a video that you had put out about how PMS is really not the best option. And you want to tell us a little bit about it, because I agree with you entirely that, as a product, I mean, I know a lot of fund managers will like they'll not appreciate this conversation at all. But as a product, I do invest in PMS myself, but I don't believe that it gives you, you know, an added alpha.
I'll give you 2-3 reasons why, as a 25-year-old, you really need to understand this. Right? First, look, the minimum ticket size for a PMS is 50 lakhs.
No, a 25-year-old will not have that money only.
Correct.
But even for a 35-year-old.
Right. But let's hypothetically assume that somebody's got 50 lakhs, right? Now, if you've got 50 lakhs, you are going to bet with one AMC and one fund manager, right? You miss out on the diversification. So you miss out on the diversification on, let's say, large, mid, small. You miss out on the diversification on multiple AMCs, and you also miss out on the diversification on style. Because a fund manager will probably predominantly follow one style of investing.
No, but the assumption here is that you have already done all of these things, base things, large, mid, small, and then you have excess money and that you invest in a PMS.
Yeah, but because we are talking about a slightly
younger audience,
okay. And I kind of brought this point out, that they will not have a lot of money. And also I can tell you, because I interact with a lot of investors in general, people with 1 crore of portfolio also have 2 PMSs, right? That again, in my opinion, dilutes the purpose, because that will not give you style diversification or fund manager level diversification the way you would want or can have. One. Second, the bigger problem is taxation.
The switching.
Right? In mutual funds, imagine you're going to invest for the next 30 years, right? Let's say you invested 100 rupee, that became 120. The fund manager thinks that, I want to sell something and move something to some other stock. When the fund manager buys and sells on the MF side, you don't end up paying tax as an investor in the MF, right? Now imagine if you're going to have a 20-year time frame of investment, there are going to be 20,000 transactions that the fund manager is doing, and you are paying no tax on that. The fund is paying no tax on that, right? There is so much of an opportunity cost that you've saved here. What happens in a PMS is every time they buy and sell, right, you end up paying a 20% on short term and a 12.5% on long term. So if 100 has become 120, right, on that 20, let's say if it is short term, hypothetically, your 4 rupees is gone as tax, right? So what is available to reinvest is 116, right? So you will lose out on that 4 rupee every time that transaction is happening.
A lot of people don't know about this though.
Of course, now we can argue that, they will also hold for 3 years, 5 years, transactions are less, the impact cost is less. But look, this is subjective of who we are actually talking about as a PMS, right?
And there's also a huge human bias in this, right? The assumption is that who you pick as your PMS manager, fund manager, is extremely good at stock picking. But once again, in today's day and age, you don't want a human bias to be there, because what if he suddenly leaves, right?
That is one. Second, PMS also has a more concentrated approach versus an MF, and which is why. So on the MF active side also you will have this human bias, right? But it's slightly more diversified. You'll have 40-50 stocks versus a 15, 20, 25 stock in a PMS.
Correct.
So even if one of your call goes wrong, the concentration risk is very high on stocks versus here. And also third is on the fee side. Of course, a lot of things have changed now, and I'm assuming it'll move in the direction that MFs have moved. But for all theoretical purposes, PMSs are on a fee aspect expensive than an MF is.
Correct.
So your cost is higher, your taxes are higher, right? And it's concentrated, right? So if for some reason your bet on the fund manager goes wrong, you should be somebody who's willing to take the high risk, high return, because the reverse works in your favor. When the concentration is high and the stock does well, you will make that kind of return as well, right? So for me, it is for somebody who's, who has a large corpus and wants to keep a small percentage of your money there, because you want to invest in small caps.
Or you want to invest in that person, right?
Yeah,
like
you want
if
to
you
invest
have a
in that
certain
person,
fund manager.
or you want to invest in small caps and very concentrated, or a micro cap kind of bet, and you are willing to see that portfolio fall 50%, but give you a CAGR of 30-40%.
So there are a lot of PMSs that also invest in pre-IPO companies,
Yeah.
right? What do you think about that?
So, look, there are MFs also who probably can give you exposure to not exactly the same kind of investing, but similar themes, right? But of course, I am somebody who believes that if you really want to play that space, then an AIF route can also work for you. Of course, the ticket size is then
Yeah.
then a crore.
That's a discussion for another day, because now a 25-year-old does not have that kind of money
But
to.
just for an argument's
Yeah.
sake, then in an AIF you can do SME also.
Correct.
You can do pre-IPO also, right? And you can do equity also. Then you will have slightly more exposure if at all you would want to do alternates. And in the AIF side of things, you will also be able to do the hedge fund kind of investing where fund is allowed to take shots,
Yeah.
right? Which typically is not the feature largely used on the PMS side of the business. So if at all the argument is that what outside of secondary market, then I think then an AIF is a much better bet than doing a PMS.
Okay, we'll do that discussion. Like, I want to talk to you at length about PMS and AIFs. But coming back to this discussion about a 25-year-old, between 25 and 30, who's starting their career, right? Or starting their investment journey. So you said 4 funds, keep it very simple. One Nifty index fund, one flexi cap fund, the one you like is Parag Parekh flexi cap, one small cap fund, which is a Nippon small cap, and one mid cap fund, which is like an Edelweiss mid cap, or anything of your choice, right? Got it. So we start with that. Then what? What do we do next?
I think prior to this, you also want to make sure that your risk is covered, right? Always make sure that you have your medical insurance in place outside of your corporate, and also you have a term insurance, because you don't want to be in a situation where something something unforeseen comes up and then you have to break your investments and you can't be disciplined here, right? This is a very large missing piece in a lot of investment strategies that people don't understand. Today, 90% of India is one hospitalization away from bankruptcy, right? In COVID, we understood when people lost their job, the first thing that they did was remove their investments. So if you don't have your emergency plan in place, your medical in place, your term insurance in place, it is going to hurt your investment. So do that before you move on from here. But from here on, I think all you need to do is these 2-3 things. First is make sure that you are doing a monthly SIP. Second, a lot of us at the end of the quarter will still have some money remaining, right? And I plow that money back into the same 4 funds every quarter outside of my SIPs, right? And the third is that a lot of us receive bonuses at the end of the year, right? That's also one piece that's not a part of your SIP calculation in general, that can be plowed back in, right? But like I said, there are 2 extremely important things for us to remember here. First, you don't want to compromise on your standard of living just because you want to achieve a number and you go all out and crazy about investing more money. But at the same time, you have to understand that returns are not in your control. What is in your control is how much can you invest every month or every year. And that should be your focus. Don't go crazy in becoming a fund manager yourself and trying to generate higher returns.
So focus on your income, focus on income avenues, income streams. Got it. But you made a very interesting point, and I completely agree about medical insurance, right? And I feel it's a very, it's a topic, especially for women. I mean, for men as well, but for women, it's a very daunting topic because they're never really exposed to all of this growing up. So tell us a little bit about that. I want to understand your personal journey, right? What medical insurance do you have? How much is your cover? What term insurance policy do you have? And how did you approach the whole thing?
I think, thank you for asking this because this is generally not discussed. And I am somebody who really believes that this is the first problem that you want to solve.
Correct.
Before you actually move on to your investments. I will give you a couple of very interesting takes on medical insurance and some common problems that I've seen people at 25, 30 typically face. First is they think that they will not need it. Right? That's the biggest problem to start with.
Yeah.
The second problem is they think there are employer covers for it. Right? But that's a that's a very small sum, or probably that does not cover your family. There are multiple other problems. Let's say when you switch a job and go to a new employer, and let's say that employer does not have any of this to offer. You need to cover yourself and your family for a medical insurance. Now, for how much, right? How much is again very subjective, but I think if you stay in metro, and today the way medical cost is going up, you should minimum have a 25 lakhs of cover, right? I have a 1 crore cover, but I will tell you a very interesting part. The journey from 25 to 1 crore is only 20% of your premium of 25 lakhs. What do I mean? Let's say if you are 25, 30, let me give you a 30-year-old example. If you are 30 and you take a 10 lakh of medical insurance, it will cost you 10,000 rupees a year. Okay, that's affordable, right? Now you will think that if I take from 10 lakhs to 1 crore, my premium will jump up by 10x.
No, it doesn't.
Your premium only jumps up by 50%.
50%, yeah.
Right? So if 9,000 or 10,000 is what you are paying for a 10 lakh cover, you can take something called as a top up. A 90 lakh top up will be just 5,000 rupees.
A top up is something you take over and above your base policy.
Right? So now you have a 1 crore insurance at 16,000 rupees.
So what's the difference between a top up and a super top up?
So what typically happens is, see, the basic concept is, why do you think that a 90 lakh cover is available to you at just 5,000 rupees, whereas the original 10 lakh cover was available for 10,000 rupees? That's the basic difference that everybody really needs to understand.
Yeah.
In India today, if you look at the insurers' data, in general it says that 80-85% of the claims are less than 2 lakhs, right? Which is why they offer something called to you as deductibles. What are deductibles? So let's say if I am willing to tell the insurer that I will not claim any claim which is less than 2 lakhs, right? Then most of the insurer problems are solved. Okay, which is right. Now look how interesting this is. Let's say I pay 70,000 rupees for medical insurance. Okay.
Premium.
Premium. But let's say hypothetically, if I'm willing to tell the insurer that I will not claim if I have less than 2 lakhs of insurance, this is called deductible. Then my insurance premium comes down to 30,000 rupees.
Less than half.
Right? Why does this happen? 2 reasons. First, because there is so much of an operation cost to the insurer for a smaller claim that they are wanting you not to claim for small claims. And second, their data shows 80-85% of the claims that are done are these smaller ones, right? So if you are willing to bite the bullet saying, I will not put a claim to you for anything less than 2 lakhs, then they are willing to give you a much lower premium, right? One. Second, now when you are taking a top up, right, it's the major part is still on your base policy. So if you have a 10 lakh rupee of base policy and you have a 5 lakh rupee claim, right, it's the base policy which is paying the 5 lakh rupee.
Correct.
Claim. It's not the
top up.
Not the top up which is paying, which is why the top ups,
the premium is less.
Premium is extremely less, right? So it is structured in a way. So let's say we were talking about minimum having 25 lakhs, right? Now when you have a 25 lakh of base policy and then you take a super top up, probably 9 out of 10 people who've taken this policy are not going to claim 25 lakhs, right? And which is why for them to give you a 75 lakh top up over this 25, they are okay to give you at even 20% of cost of this 25 lakhs.
Because you may never use it only. Yeah. So tell me, what policy do you have? What's your base policy? What's your super top up?
So my base policy is 25 and our top up is 75.
No, like which company?
So we are using Reliance at this point in time.
Okay. So you've changed it, or has it always been?
Look, insurance actually, very honestly, it's a very interpersonal thing.
It is,
You want to work with somebody who will make sure that the claim is settled.
Yeah.
Right? So there is no research in why we've selected this, right? But we have a very close family friend who does this business.
And you go with them. So it's I mean it's convenience more than
convenient,
anything else.
yeah.
Who will help you settle your claims if and when you need it?
So look, honestly, we've not done a lot of research. I don't even know, if you ask me what is good and bad about this
Yeah.
policy, I would not know. It is just interpersonal because this guy is a very close family friend. We just go with it.
Fair enough, fair enough. So you don't have you have a base and you have a super top up. You don't
Yes.
have any other policies like say cancer care.
Accidental, yes.
Yeah.
We have an accidental policy.
Okay.
And it's a part of
Part of
the
the overall
the
cover.
same overall cover.
And do you have term insurance also?
Oh yes, I think term insurance is extremely important, and you should have a minimum 10 times of your annual take home as a term insurance.
So interesting. I don't have a term insurance because when I was trying to get a term insurance at that time, I had somebody who advised me, and I don't know. I mean, again, it's who you meet and how they advise, right? So this guy told me that if you have a sizable mutual fund corpus and if you are a regular SIP investor over the years, you may not even need a term insurance.
I will concur with that, and I will tell you why. Look, personal finance is very personal, right?
Yeah.
You may have a very different thought on the same subject that I might have, and you and I both will be correct.
Correct.
Right? Now, what's the concept of insurance? The concept of insurance is that if Kirtan is a earning member and the family's lifestyle in some sense depends on Kirtan's income as well, may not be completely, but to whatever extent, right? Then there has to be a replacement of Kirtan's income to the family if Kirtan is not there, right? Now let's hypothetically assume Kirtan gives 100 rupees to the family each year, right? And if Kirtan is not there, that insurer or insurance needs to give that 100 rupees each year to the family so that the lifestyle does not fall. But what if Kirtan has investments equivalent to that? If Kirtan is not there tomorrow and this investment is put in a fixed deposit also and can give 100 rupees to the family, then Kirtan does not need a term insurance. Right? But when does this discussion kick in? This discussion will kick in for a professional who spent 10, 12, 15 years and has
the corpus. Yeah.
But somebody who's young, right, and he's just started, they don't have a corpus.
Correct.
But the family is going to be dependent on their income going forward.
Correct.
So for a younger audience, it is a must to have an insurance. Another problem is that you might want to relook at this every 5 years, because when your income goes up so significantly, I know people who have not topped up their insurance.
Because they feel now they have a big enough mutual fund portfolio.
Yeah, so you might want to balance this. Whether or not do you have a big enough portfolio for you to not top up your insurance.
Because at some point you might even use that mutual fund portfolio to say buy a house, and then again you are stuck with no corpus.
Because that house is not going to act as an investment to replace your...
And in all probability you would have taken a loan against that house which has to be repaid if something happens to you. So term insurance comes handy at that point. Okay, so I wanted to talk about direct stocks, and you said to me that you don't do direct stocks, you do only large caps in direct stocks. But it's interesting because, I was having a conversation with Ramesh Damani at the start of when we started Money Mindset, and he said, Sonia, you will be able to make money through mutual funds, but real wealth will only be created through direct stocks.
Yeah.
And it's very interesting to me that you don't buy direct stocks. Why is that?
I think very honestly, I don't think I really have the skill set. So I do direct stocks only on the large cap, but mid and small, I leave it to the mutual fund managers to kind of end up pick that in the portfolio and the scheme of things that I do. But because it is in my portfolio, mid and small is equally split with large. So out of the 100 rupee portfolio that I manage or have for myself, 40-50 is mid and small in that context, right? So I have a very decent exposure to mid and small, and over a longer period of time, I think that solves my problem, because let's say, of course, 12% is where you really want to do math. And I'm just giving you an example here that your portfolio becomes 4 times at 15% CAGR, right? So let's say you have a crore today, 10 years later, it'll become 4 crore, 15 years later.
But 15% you can't assume, na? You don't get 15%. Okay, you're saying given that mid and small caps may perform better.
Yeah, so I'm assuming mid and small will do slightly better than the large caps of the world will do, right? So while we talk about Nifty, 12% is okay. But mid and small, probably the assumption is that they will do
Better.
A notch better than large caps. So what I typically end up doing is, because I don't really think I have the skill set to do this, I do direct equity exposure only in large cap, and mid and small I leave it to the fund managers to be able to do it.
But you're okay with that? See, I'm asking you this because I'm in the same boat. Like, I also find it very hard to pick. I mean, there are non-index large caps that I buy and I hold. But, you know, picking those multi-baggers, those small cap stocks which go on to become like large caps, it's a hard process. It's not easy.
It's a
And
very
for
hard
someone who
process.
is day in and day out in the market, if you can't crack that, there is a little bit of frustration that creeps in. Do you feel that as well?
Not really. I think I've trained my mind to understand that I don't really have the skill set to do this.
Acha.
Right? Because look, it is not as simple as it looks.
Yeah.
Right? And because we are talking to retail investors who are going to hear us, I think this is very important for me to really communicate to them that it's not as easy as people make it sound on the internet.
Yeah.
Right? Because first is your skill set to be able to pick which sector is going to do well. Second is your skill set to be able to pick which stock will do that. And third, your behavioral bias that you will really be able to hold. Right? Suppose if I say that I invested a crore in a particular stock and it has become 3 crore, how many of us are still going to hold on to that 3 crore assuming or expecting it will become 30 crore? 90% will drop out.
Correct.
Right? So,
And in that 1 to 3 crore journey also of a stock, you would have seen a 20-30% drawdown at some point in time.
Absolutely. So, skill set and behavior, most people don't have it. At least I don't have it.
Yeah. But it's very like, you know, candid of you to admit. I mean, given that you're in this profession. Okay. A very important topic before we wrap up. Owning or renting a house, right? I want to know your journey. Were you born into privilege? Do you live with your parents? Did you need to ever buy your own home?
So look, for all mathematical purposes, you and I both know that the answer is renting, right? Because today, even in Bombay, you will be able to, at 2-3% of the value of the house, you will be able to rent the house. A crore rupee worth of house, you will get at 20-25,000 rupees a month as rent, right? So mathematically, renting is the best way to go ahead. But if you really ask me, because this is personal finance, I really think you should have one house to stay in. You might not want to, or I might not want to invest in real estate beyond the house that I stay in, but I really feel that you should have one house to stay in.
Look, a lot of us who live in Bombay, whose parents have lived in Bombay, we have the privilege of owning a house in which our parents live, right? So they've done the hard work for us.
Yes.
But for people who come from outside, you're saying renting through and through.
No. So I think the best way to do is a combination. And I'll explain to you how I have done and how I think it makes a lot of sense. So why do people who are very young cannot or should not buy a house, right? Because first they will not be able to afford the EMI. A 2 crore house today at 8.5% for 20 years will cost you 1,70,000 rupees as EMI, right?
Not worth it.
How many people will really be able to do it? One. Second, once you bought this house, your risk appetite goes down as a young folk, right? Will you be able to switch jobs? Will you be able to do a startup? Will you really have the mobility? Let's say you are in Bombay and tomorrow you get a good opportunity in Bangalore. Will you really be so comfortable to do this?
Correct.
Right? And third, it'll kill your lifestyle. Right? If you end up spending so much of money on your EMI, how are you going to live? Right? So there are 3 major problems. I think young people will not, should not, or cannot typically end up buying a house.
I think there's a big opportunity cost also. You'd rather put that money in the markets and make that
100%.
13-14%.
100%. So that argument I'm not even talking about, because I know renting is cheaper and investing that money in the market makes sense. I'm just talking about the other side, right? Now, what should you do? Because I am saying that you should have a house. How do you then get a house? I think all you want to do is make sure that you give yourself some time before you end up buying a house, and that solves all your problem. Now, what do I mean? Right? Let's say you start investing as soon as you start making money, and build a corpus so that you have 40-50% of the value of the house available to make a down payment, and that solves all your problem. Now, why do I say so? Right? When you rent, let's say when you are new or new to work or very young,
in your 20s,
what you're trying to do is on a 2 lakh rupee salary, even if you want a 2 BHK to rent, you will be able to get it at 40K a month, right? Of course, depending on where in Bombay you are.
Where is this? Where do you get a 40,000 rupee 2 BHK, Kirtan?
But I'm saying,
let's be honest.
I'm saying 2% rent yield is the math that all of us do, right?
Yeah.
So on a 2 crore house, a 2% rent yield is 40,000 a month.
Right? Not in Bombay, but Pune, Bangalore mein.
ठीक है, चलो 50,000 a month ले लो, right? So let's say 50,000 a month you've been able to do. That does not compromise your standard of living, because on a 2 lakh rupee salary, 50,000 is still 25%, right? Whereas I was okay doing a 30% EMI when we started the conversation. So it gives you a place to stay. You have 40%, which is 80,000 rupees that you are investing, right? You are still mobile. You will be able to go wherever you want to go. And this is not a headache on you that tomorrow you get an opportunity you will not be able to risk.
Correct.
Right? So it takes care of your lifestyle. It gets you a house and you're still investing currently. Let's say 5 years, 10 years, let's say 10 years later or 15 years later, right? What will now happen is your salary has gone up significantly, right? Even if I consider 10%, let's say, 10% hike each year, your 2 lakh salaries become 7.5 lakhs now. Okay? Now, if you end up buying a house for yourself, right? You've already accumulated 40-50% of the monies that you need to buy a house to make the down payment. So now when you take a loan, the loan is much lower. Of course, the value of the house would have gone up. So 2 crore house will become, let's say 5 crore at 6%, right? So now you will still have to take 2.5 crore rupee loan, but you have a lot of comfort because you have 7.5 lakh rupees as salary, right? So what happened is, when you take a house at 35 or 40, you've not compromised on your lifestyle all throughout from 25 to 40. You will not compromise on your lifestyle going forward from 40 onwards, because your salary has gone up, and now versus the salary, your EMI is lower. You also have a house to now stay in, right? And by 40, largely people would have cracked the code of what
they want.
Yes.
Or where they want to live. Because, I mean, most people I speak to who have achieved a lot in their life don't buy their first house before 40. And when they buy it also, the decision is very emotional. It's not an investment decision at all.
So I think this is exactly what the young audience needs to understand. Build a corpus for 40-50% of your EMI, of the value of the house, and then take a house. You will not compromise on your lifestyle. You will still have a house, and by that time you will be much stable also.
Okay, very, very interesting. I mean, very sane advice actually across all fronts. Thank you so much for joining us, Kirtan. And I always like to let people go by asking them what is the meaning of money to them, like what does money mean to them. And for someone like you, you're a financial educator, you have trained several people over the years, you manage 1,000 crores worth of AUM. Hats off to you for that. But what does money mean to you?
I think money for me is independence. It should give me the ability to do what I want to, and not because I have to. I think that's what money means.
Wow, that's amazing. That will stay with me. Thank you so much for joining us on the Money Mindset.
Thank you so much for having me, Sonia.